So back to the ROIC tree. So did anybody get a chance, like I said, to go through the ROIC tree to think about the analysis? I know you didn't have a lot of time. So I'll at least mention a couple things. So when you do the 5-year ROIC tree analysis, as I said, there's 3 drivers that we're looking at. The first is tax rate. So on an overall basis, we can see that Walgreens ROIC went from 12.6% in 2010 to 11.6% in 2014. Basically a decline of almost 8%. Right? So the first thing we noticed is that their tax rate went from 38 to 43, an increase of almost 13%, and their pre-tax ROIC, though it improved, basically ended up at the same place 5 years later, no change. So all of their after-tax decline in ROIC was because they're paying more taxes. So what I want you to do is I want you to go back 60 days to our first couple weeks of class, and I want you to remember that Walgreens was dominating the headlines of the Wall Street Journal and the Financial Times when we started this semester. What were all the articles about Walgreens about? Anybody remember? We talked about them in class. There's the acquisition of Boots, but what was in the papers? Yeah, they were talking about doing an inversion and moving from the U.S. to Europe to pay lower taxes. And what I'm telling you is that shouldn't really be a surprise when you look at this company that's paying basically 40% in taxes, right? We just had an election last night, and one of the reasons why I think the Republicans did very well is people were getting tired of paying high taxes, particularly in Maryland. If anybody saw that, the big Maryland governor surprise was all about the taxes. And basically I think that's why was Anthony Brown, who was actually here on campus. It must have been a pretty depressing party. Did anybody go? Because they thought they were going to have a big celebration, and it was kind of a shocking loss. And like I said, I didn't really follow the election, but what I heard from the pundits was that the Republican candidate was all about Maryland's taxes being too high. And as somebody who pays Maryland taxes, they're ridiculously high. I should really live in a different state. But that because we pay like 8%. You pay 8% of your income. So add that to 35 for federal as a corporation. Add that on top of 35 federal, and you pay a lot. Unfortunately, Walgreens is faced with living near Chicago. So that's the problem. Is in Illinois, it's another very high tax state. So, as I said, when you start thinking about financial analysis is about telling stories. So we want to do some storytelling. And the storytelling here is Walgreens' tax rate is why they wanted to do an inversion, set off a political firestorm. They basically said they didn't want to do it for the politics, but I'm telling you, when you look at the dollars, it's pretty substantial. That aside, pre-tax ROIC didn't change. What's going on here? Well, their operating margin fell by almost 9% from 5.1% to 4.7%. So basically, they're making less money in every sale. Now, during this 5-year period, they improved their productivity by 8.7%. So they basically mitigated the margins from an ROIC perspective declines by getting productivity gains. Okay, so it was a wash. But I'm telling you, as a company, long term, there's only so much productivity improvements you're going to get, and eventually it's going to be a story about the margins. You can't see those margins declining. That's part of the reason why I think the Boots acquisitions happen, because the Boots acquisition is all about growth and margin, right? And that's the context that was set up in the Jefferies Analyst Report that I had you read, right? So what's behind the decline in the operating margin? Well, second level analysis. It's gross margin minus SG&A minus depreciation. Well, what we see for Walgreens is their gross margin actually improved slightly from about 29.7 to 30. Their real challenge is they spent even more in SG&A than their gross margin improved. Their SG&A went from 23 to 23.6. And their depreciation went up a little bit. But primarily, SG&A went up faster than gross margin. By the way, go back to the Jefferies report. What was one of the headlines from that first page of the Jefferies Analyst Report? What did they say here? Start to relate the story to the drop in margins. How's Walgreens going to be impacted by this go forward? What are they saying they're going to do? New CFO focused on benchmarking and aimed at SG&A opportunity. Basically, they're going to knock $1 billion worth of overhead cost. That is directly related to this. Okay? Because relative to their peers, they're spending more for lower margins, and they're seeing it go up faster than what their margins are on. So they're obviously putting some targets there. Right? Productivity. Where did the productivity gains come from? Well, it's working capital, it's facilities, and tangibles. Their big gain in productivity came from working capital. 33% decline in working capital. 3% decline in PP&E to sales. Think of that as store productivity. Didn't really do a lot in the way of acquisition. So even though this went up 10%, a tiny number to a slightly less tiny number or slightly more tiny number is not really going to be a big change. So for them, it was really about the working capital improvements. But that's the point. It's working capital, it's not seeing the store productivity, and it's the SG&As. Those are the storylines. And when you think about it, that's really what Walgreens is saying that they're going to be working on a go-forward basis. That's what they're discussing and engaging with on the analysts. And those are going to be the important drivers when we start to think about their performance of the business on a go-forward basis. So that would set us up to do our as-is valuation. And that's what I'm saying. It's good to have that level of context when you start getting into the as-is. Now, go a step further. The other analysis we had to do was the CFI. So for the CFI, if we took our model, we have all these out years that we forecasted. One way to set up your CFI is take the forecasted years, 2015 to 2025, hide, don't delete, because it'll wipe out your valuation, but hide the forecast years. That'll move the total column right next to it, and then the percentage of the total. So this is basically the CFI that you'll need to print out and analyze. Right? Again, there's 4 parts of the CFI that we need to analyze. Right? First, we're going to talk about the free cash flow, the operating point. So gross cash flow was $17.3 billion over the last 5 years. That's the sum total of the last 5 years. Again, for most of the 5 years, pretty steady in the low 3 billions. It peaked in 2011 at 38.45 and then settled in 2014 at 33.58. All right, so again, fairly consistent and stable cash flow from their business. Gross investments, $6.3 billion. Okay, they basically put 37% reinvestment rate back into the business before acquisition. Now, again, what's interesting is their CapEx has been pretty steady between 1.4 and 1.7 billion a year for the last 5 years. All right, so they've had fairly stable CapEx. What's really been different has been their working capital, and particularly 2012, 2013, they took out well over $1 billion from working capital. So what you can see is a clear linkage between those 2 years and the improvement in the ROIC working capital. It was the 2012, 2013 improvements that led to all those productivity gains, which offset their margin declines. Okay? And we can see the direct linkages between the 2 reports. Right? That's what helped their productivity, and this was the cash impact of that productivity gain of their business. Right? So that gave us about $6.3 billion of gross investment. Then, in terms of free cash flow, they didn't really do much in the way of acquisitions. They did some bite-sized acquisitions, a couple $100 million a year, basically leading to free cash flow of about $10 billion. On a non-operating basis, they ended up with $3 billion of CFI after spending about $7 billion of non-operating cash flow. All of that was spent in 2012. Right? So obviously, we'd want to figure out what that non-operating investment was, but that's really where a bunch of their cash got tied up. It was in the year 2012, almost $7 billion. Now, of the $3 billion they had left, what happened on the financing side? They borrowed about $2.1 billion of net debt. Most of that occurred, almost $3 billion, in 2012. So obviously they used debt to finance whatever investment they had made in 2012. Now what's also interesting is they paid about $4 billion worth of dividends and about $6.3 billion worth of share repurchase. If you add the 2 up together, it's almost $10 billion. Or another way of saying this, 36.4 plus 24.4 works out to be about 60%. They had 63% free cash flow before acquisitions, 58% after. They paid basically all of it out as share repurchase and dividends. So Walgreens is literally taking all of their free cash flow and they're giving it to the shareholders over time. Now, they've also changed their mix because 5 years ago, they paid $540 million in dividends. Last year, it hit almost $1.2 billion. So they've been steadily increasing their dividends. But notice they've been scaling back their share repurchase. So the share repurchase used to be $1.8 billion. Now it's only $705 million. It's the two together. Okay, so as they've been ramping up their dividends, they've been ramping down the share repurchase. But if you really look at the two together over time, they've been fairly consistent about paying out their free cash flow, right? So they're basically just saying we're going to pay it out, and the discretionary amount of the free cash flow is really what the share repurchase has been. Otherwise, I think they feel comfortable enough to raise their dividend, but nonetheless, that's what we're seeing with the payout rate. Okay, so now we kind of get a sense of what they've been doing. Except now is where we really reach a point of demarcation. Because one of the things we know is that Walgreens has announced that they're going to buy the rest of Boots. So, Alliance Boots. So basically, they're going to take over that company. So let's talk about our AsIs valuation. Well, if we put in a G of around 3%, a little over 3, right? And we put in the estimates, then one of the things we'll see in the ratios is these two big growth rates for 2015, 2016, that's the acquisition. And we know that that is inorganic growth. That is not organic growth, right? So, because when you buy somebody else, you're going to literally slap their revenue into your revenue, add them together, suddenly you're a bigger company. So what's really going to matter is once this acquisition is complete, what happens? Well, here's the thing about Bloomberg. We don't really do this too much. But in the EEO screen of Bloomberg, I can switch this from values to growth, and this will give me percentages. This is the revenue growth rate for the next 2 years, based on the earnings estimates. But this is the revenue growth rate for the following 2 years, basically 1% and 9%. So when they get back to the organic growth in 3 years, it's 1%. Right? Now, you'll also notice that the first 2 years are more heavily forecasted. Meaning there's a lot more analysts putting numbers in for 15 and 16 than there are for 17 and 18, because the further you get out, the less certain you are, the less you want to put your name on the line as an analyst, because every data point is tracked. But of the few analysts that have forecasted, if we want to use that as a baseline, it gives us a sense of 1 and 9. So here's the point. When I do my as-is, then I can use the 1 and 9. I just did some simple rounding. But I use 1 and 9 for the following 2 years. So I got the first 4 years forecasted. Now, here's the other thing. When I did my multiple analysis, I basically came out EV, so I'll go here, on my RV screen. And when I did the multiples that we did in class last week, EV to sales divided by the EV to EBIT for Walgreens basically gets me a 5.8% margin. So basically this number, which is operating income is the EBIT margin, that's the number that needs to be 5.8%. Oh, sorry, don't want to change that. Undo. That's the number that needs to be 5.8%. Okay, so here's the next question, which is if this is 5.8% after a couple of years into perpetuity, and this is the revenue growth rate, then if I start with 3%, which is the long-term perpetuity G, and remember that the individual growth rates for years 6 through 10, they don't have to be 3%. Like we could make it 5, going down to 2, like we use some variability. But the whole point is we know that long-term, company is going to grow probably about 3. So we're eventually trending down to that 3%. But here's the interesting thing. If you put 3% in with these margins, you get a $64.23 share price. And right now, Walgreens is trading at 65. So we're now pretty much within $1 of their current share price in terms of the as-is. Right? So that's essentially how I want you to start thinking about the as-is. That's what we did with Walmart and the retail firm. That's what we're now doing with Walgreens. Right? Now, here's the point. Here's the real question. Walgreens is talking about the Alliance Boots acquisition. I gave you that in the Jeffries report. As part of this, there's this table. And what this table basically says is here is the EBIT margin, which is the operating margin, EBIT divided by sales. That's the 5.8 that we pulled out of the market multiple. And basically, Walgreens in 2014, we saw this from the ROIC tree as well, this is their pre-tax operating margin. Boots, who they're buying, is closer to 12%. CVS is at 9%. It's the margin gap. This is what they're focused on, closing the margin gap. This is why they're buying Boots. Talked about the mix of business on Monday, right? Front of the store, back of the store. Back of the store is basically the pharmacy. Pharmacy margins challenged because most of that is now generics. There's not a lot of growth in generic revenue anymore because most of the generics have now been converted and the margins on generics aren't all that good. So it's really about the front of the store. That's Alliance Boots. Alliance Boots has that really high-end front of the store, right? They're the cosmetics company, right, at the front of the store. So what Walgreens is basically saying is we're going to take them over and our margins are going to go up and look a lot more like Alliance Boots. Here's the other thing. One of the other analyst reports I gave you is from Deutsche Bank. Here's the Deutsche Bank analyst report. Scroll down. Here's page 4. This is a table of the new management team that Walgreens has basically announced that's going to be part of the merged entity. The Walgreens Boots merged entity. Here's the new leadership. Here's what's interesting. This little box over to the side. The key operational roles of the combined company are being filled by either legacy Boots managers or new hires in the case of CFO Tim, is it McElvesh or Meklevesh? But basically, what are they really saying here? Where are these people coming from? Boots. The bigger company's buying the smaller company, but it's the smaller company's leadership that's going to run the bigger company. Matter of fact, the person that's running North America from Walgreens was the person that used to run all of Boots' retail front end. And that's who they're bringing in to run the Walgreens people. Now, why do you think Walgreens is doing that? Yeah.
Make sure that they don't mess up Boots'
Yeah, they don't want to screw up what Boots has accomplished. But why else do you think they might be doing that?
So they can bring Boots' margin into Walgreens.
That's right. That's the story. The story is, hey guys, we've got these people coming to work with us. We've already told you we're going to transform the front of our store so we look a lot more like Boots. We're going to be improving our margins. Now, here's the thing. The analysts are basically saying up here in the front, might take us 3 to 5 years to get there, to improve to that level of cost structure, because there's going to be some time and some changes and some integration stuff, but we're going to get there. And oh, by the way, we're putting the people that know how to do this in there. So here's my question to you. Does the market believe Walgreens?
Really?
Does the market buy into the story? And what data do we have to tell us whether or not the market buys in this story or not? What do you think? Yeah.
Forecasting EBIT is still
That's right. This is the EBIT of Alliance Boots, CVS, and Walgreens. And we basically just did an AsIs valuation, which says this is the forecasted EBIT. 5.8 with relatively low growth is the current stock price today. So what I'm telling you is at the current stock price today, the market does not believe Walgreens. They don't believe the story. It's not that they don't believe that there's going to be some improvement, because over the next 2 years, they're expecting an operating margin in the low 5s, which will eventually get to almost 6. But they're not giving them credit for getting to 9 to 11, which is where CVS and where Boots currently is. So this is where we get into the concept of a final valuation. This is where you get to play Warren Buffett. Is the market right? So number one, does the market truly understand Walgreens' strategy and basically say, I don't think they can execute? Or does the market not truly digest their strategy and the transformation they're going up upon and the market's just missing a value story here, and now's a really good time to be in the business. What's the right answer to that question? That is your homework assignment for Monday. 500 words. That is the final valuation. That is what's going to create the buy, sell, hold. Right? And by the way, that is something that there's not true consensus on in the marketplace. Because if we go right now to the analyst ranking, ANR, you will see there are 13 analysts who say buy, and there are 13 analysts who say no, Walgreens is fairly priced, and there's 2 of them that think they're overpriced. But that's the point. If you look in the world today, there's no consensus in the real world for what this is. And that's why there's not necessarily a right answer here, but we have to come up with an opinion, and we have to basically write that out, and that's going to be the difference in the buy, sell, hold. It really comes down to those 2 questions. Do we believe them? Do we believe that this is achievable? And what data do we have to support it? So a couple things to help us answer that question that we should be including in our analysis. 1, what's the industry growing at? Well, we got an IBIS World Report. If I go to the IBIS World Report for pharmacies and drugstores in the U.S., and I go to the end, here's the industry growth rate. IBIS is saying 3%, 3%, 1.5%, 3%, 2.6%. Basically, if you look at the next 5 years of industry growth, that's around 3%. And that's already what Walgreens is being priced at today. So if you kind of look at the current share price, the market is kind of saying, we think Walgreens is going to grow with the market. So the growth story of getting in all this cosmetics, it's not in there. They're based because they're not growing any faster than the market is already growing at 3%. The market's already growing 3% doing what they do. So as I said, the margin story is not in there, the revenue growth story is not in there, but nonetheless, this is what the industry is growing at. So they have to be growing much faster than this industry. And what does that mean to a share price? Right? By the way, we can do that, which is if we go in here, how do we change this number? We change the EBITDA. Takes 5 years. 1, 2, 3, 4, 5. Starting in the 5th year, what if this becomes 8.5, which means this becomes close to 7? What if this becomes 9.5, which means this becomes close to 8? And oh, by the way, I'm now at an $87 stock price and present value. So that's the point. If in 5 years they can get margins that approach CVS today and or Boots, this is an $87 stock price. And they're in the 60s today. That's an immediate buy. And so let's go here. Target share price. This guy from Susquehanna thinks they can do it. This guy from Cowen and Company doesn't. Deutsche Bank, not really. So that's the point, is that we have to come up with our point of view, somewhat fact-based, somewhat interpretive, but basically that's what we're putting into our model. And so it's no longer when you do the final valuation, it's no longer what growth rate do we need to get to the market price. It's what growth rate do we actually think this company can actually achieve. It's no longer what's the operating margin that the market is using to justify the current price. It's what level of margin do we think the company can achieve. And these are the questions that we have to ask. So when you do EIC, so in a way you're doing a little bit of an EIC here. All right, EIC is not just about doing the beta and the RV screen. It's about the business context behind that. And the business context, the dynamics of their industry that we need to understand are that they have 2 parts of their business. One is a pharmacy, and that pharmacy is not growing very fast anymore, and it has tough margins. And then they have the other part of their business, which increasingly is going to look more like a higher-end cosmetics business. And that's what they're really saying they're going to bring to the U.S. That's what's really different about Boots, and that's a growth opportunity for them in their minds, and that's a margin opportunity for them in their minds. And right now, that's not priced into the stock. So what could that look like for our business? So now we start doing our multiples analysis. Right? So as part of your homework assignment, you're going to have to do a multiples analysis. So I'm going to go here, and I'll go to the RV, and I'm going to start looking at their peers. Well, by default, this is the peer list you're going to get for Walgreens. People like CVS, but also Costco, Kroger, Cisco. Now, that's not the Cisco networking company. That's the food wholesale, Cisco. Safeway, Sprouts Farmers Market, Casey's General Stores, I don't know if I would consider them a true competitor to Walgreens or Whole Foods for that matter. So here's the thing. We're going to use the starting peers as the Bloomberg peers, because Bloomberg curated this list. And basically what Bloomberg came up with is their real peers are CVS and Rite Aid. Okay, so that's the peer list that you're going to do the multiples analysis on. The good news for you is it's only 3 companies. And you've already done most of the first company here today in class. So you're going to have to do the other 2, CVS and Rite Aid. Right? And really what I want you to understand from the peers, beyond the ROIC, the G, and the margin, is to focus on the margin. Because that's the point. What is the margin that the multiples are using? And is that margin the same as the margin in this table? So is the margin in the enterprise value to sales that's being used by the market today the same margin that these companies are actually achieving? And so here's what I'm getting at. Is part of Walgreens' challenge the fact that the analysts think that longer term that this market's going to get tougher, and so therefore it's not really about them improving, it's that their market is actually going to get more challenging. That's really what the EIC is about. So is it really just the market stays the same, they start becoming a high-end store, and suddenly they start doing better? Or is it the market's actually getting tougher, so by doing better, what they're actually doing is kind of staying the same, because otherwise they would be doing worse? And so that's what we're trying to get to with the real EIC analysis, and that's what we're trying to infer from some additional data that the multiples are giving us about what the long-term pricing needs to be and the long-term margin. So that's going to be the key data to start to help you assess that. What is the long-term margin of CVS? What is the long-term of Rite Aid based on their trading multiples today? What is our understanding of the industry? And then how do we tie this into a scenario? That's what I mean by storytelling. It's starting to tie these disparate things into a compelling story. Now, there are a couple more peers that I think I want to add to this list, not because I want you to do the analysis on, but if they really are changing the front of the store, then their peer group may start to look a little different. Because there's other companies that at the front of the store they would be competing with in the future that they're not competing with today in North America. So for example, if they're getting into higher end cosmetics and services along those lines for makeup, who might they be competing with going forward that they're not competing with today? All right, it could be like an Avon, a Sephora. Somebody earlier said, we don't have as many females in this class, so it might be tougher. But the females in this class, who else? Where else do you get your makeup? Some of you wear makeup. Not to put you on the spot, but Ulta, so they might be a competitor. And so that's what we started talking about in one of the previous classes. So I started editing the comparables and coming up with a custom list, and we started coming up with these custom peers. So we looked at Ulta and Sephora. Now, one of my students made an argument for GNC. If you start thinking about health and wellness and all of the vitamins and stuff that a GNC would sell, so maybe they're going to be a potential comp. And then the other one is we throw in Revlon and Estee Lauder. And here's why. It's a different business in that Estee Lauder is a wholesaler versus a retailer. But one of the things about Boots is that Boots has their own private label makeup. So the question is, if I have my own private label makeup, what kind of margins could I make on my own private label markup at retail? So at least what kind of margins does an Estee Lauder make? So this wouldn't be on 100% of Walgreens sales, but at least it could be on a part of Walgreens sales, which could explain why the Boots margin's higher. Now at the end of the day, these analyst reports that I've given you, they actually have a forecast for margin. And you can use this as part of your inference. But that's the point. I want you to come up with your story in 500 words that explains the final valuation. And then I want you to submit that final valuation. That is your homework due 10 a.m. Monday morning. So, homework assignment. Number 1, final Excel. Number 2, 500-word write-up. Number 3, multiple analysis. CVS, Rite Aid, Walgreens. The other multiples are really to help you with the final valuation. You only have to do the detail one on those three companies. Questions about any of that? And that's where we're going to start with that question on Monday. What are they really worth? Is now the time to buy? Is now the time to hold? Or is it time to sell? What's your opinion? That's got to be part of the answer to your 500 words. What's your opinion and why? And this is the data that supports that conclusion. We're interweaving the numbers with the story. And you're going to tell me your story, and this is where we're going to pick up on Monday with the rest of the Walgreens valuation. Okay, questions? Great. See everybody on Monday.